Good evening, everyone, and welcome to today's Technical Tuesday. Firstly, I want to start by saying I hope you're all well. I hope you've been catching some successful trades this week. We've had sort of a good week this week. GJ's up about 120, 1 to 20 RR. Gold's running about arguably at one point 1 to 6. I think we had AUD/USD which just got stopped out, but if you're still in that trade, that's running about 1 to 8, 1 to 10. USD CAD unfortunately got stopped out. NZD/USD running about 1.3, 1.4, depending upon where your entry was. So there was some sort of good trades, good opportunities that we did capitalize on, depending on the currency pairs you traded. But one thing that caught my eye very nicely was gold, and this is sort of going to be the backbone of the video, capitalizing on areas of interest and how to actually use them effectively. So without further ado, let's get into this video. So firstly, what I look for in an area of interest is basically sponsor candle, inefficient pricing, areas of premium or discount, or basically a point where price is going to react off. Now, I call this an area of interest is because that's exactly what it is. It's an interest in that specific area. It's an area where I sort of feel price will react off in a specific bias. So for example, if my favored bias is bearish, my area of interest in that specific limit is bearish. Now there's two ways to go around these areas of interest. Firstly is the aggressive way. You can put your limit at these areas of interest, and then sort of take an entry upon there. But as explained in yesterday's market outlook, setting limits to a certain extent is risky, as the whole trade just goes on autopilot. You're just relying upon that limit in order to pay you a profit, which to a certain extent is a risky game. That's why I sort of wait for a reaction of my areas of interest and then capitalize accordingly. So a good example is on gold and Euro USD, as those were two trades that we had two different areas of interest. So it brings that conflict on which area of interest do you use when there's two areas of interest. So I'll just explain quickly what I was looking at on gold for this specific trade, and more specifically this area of interest here. So scaling into the 15-minute time frame, and just looking at overall structural this overall structural sentiment on gold, we've had this major sell-off, again taking out these 1, 2, 3 prior major lows on the hourly time frame. So again, sort of using the bigger time frames in our bias. In saying that, this was an intraday move, so I was focusing more on the lower time frame, seeing how they react to certain areas. Now, just looking at sort of market structure over here, we're making higher highs, higher lows, higher highs, higher lows. In this, ultimately forming this redistribution schematic, as mentioned on the weekly market outlook. So if you haven't watched that video yet, go back and watch that. More specifically at the end, towards the end, I did talk about gold and then USD CAD. So yeah, if you haven't watched that video, go watch that. I sort of talked briefly upon the redistribution schematic we're forming, but again, Wyckoff is for a whole new topic, which I am working on the sort of Wyckoff sentiment. I want to portray the best value possible when it comes to that, as that is a major key, not only towards your trading game, but refinements, understanding reaccumulation, redistribution, accumulation, reaccumulation, how to find out sort of shift in order flow, shift in momentum, shift in market structure. It all sort of links to the Wyckoff schematic. But long story short, we were forming a redistribution schematic. Upon forming that schematic, we had that major sell-off, clearing out the this prior low here, this prior low here, and this prior low here. So all sell side liquidity has been swept. In addition to that, we did have this 100 pips sweep, and this was a reason I wanted to actually talk about on the market open, but I didn't actually get a chance to mention it. I believe the market opened around this area here, so just sort of, so yeah, we did have market open around this area here. I did witness it live. We had that major sell-off. So this is what I mean upon sort of doing the analysis on Sunday, as if I had a short bias, the take profit would have already been hit, and it would have created confusion from sort of your perspective in, is the trade still valid or not. So yeah, this is why I sort of moved the market overview to a Monday, and I sort of give the trade ideas beforehand, and then explain it on either Monday evening, Monday night, or even Monday afternoon, just depending upon when I get the recording sort of set. But anyway, scaling back onto what I was looking at and why these two are my areas of interest. Again, just looking at our market structure: higher, 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 low, higher, 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 low. We failed to create that new higher high. By all means, this is no sort of confluence to sell, as we haven't really seen a significant break in market structure upon having that small retracement down, arguably, as if we ignore this prior sort of price action, we can just consider this as a retracement in order to go higher. We have that small retracement up, failure to take out this high, and so arguably we've created a lower low, lower high, breaking market structure now, create that lower low, lower high, lower low that swept this previous engineered swing low. In addition to that, that's sell side liquidity has been swept, and we ultimately have created that sign of weakness, or also known as ST in phase B. In addition to that, we've created engineered lows, this meaning a double bottom has created, and we've seen some choppiness from the sort of bullish sentiment slash bias, this attracting retail to buy and putting the majority of stop losses below this area here. And within this wick here, not only has this wick sort of got prior orders to it, but there is a lot of liquidity remaining here, and arguably within these wicks there is a lot of imbalance. So it is a good area for rapid and impulsive price action to just sail straight through. In saying that, we've got that massive bearish candle to follow. Upon having that 100 pip sweep, we've reacted bullishly upon market open and sort of been bullish ever since. Now if we look at an overall structural point of view on gold, we are in a premium price range. So again, this is a very good confluence in itself, as it suggests that banks are getting the best price when it comes to selling gold. So we've reached a substantial level, and yeah, why was this my area of interest? Firstly, scaling into the 15-minute time frame, we saw all this prior inefficient pricing, these massive bearish Marubozu candles that have imbalance present, but just look at sort of the bearish continuation. We have 1, 2, 3, 4, 5, arguably 5 continuous bearish candles, taking out sell-side liquidity, etc. So I did feel this area here needed to be rebalanced with. In addition to that, we had this on a very smaller time frame. You could probably see an accumulation schematic, sort of build up of orders, and then ultimately broke market structure here. Had that small pullback, not enough to get into a long, but ultimately been in this contraction range ever since. Now, if we actually look at this contraction range a bit more deeper, we understand that this is a distribution schematic. So you've had a redistribution as an overall schematic inside of a distribution schematic. So that's sort of the stage I want you lots to get at, is when you can spot schematic in schematic. And what I mean by that is you're scaling from one time frame to another time frame to another time frame, and this generally means you're going from a bigger time frame all the way to a smaller time frame and scaling into them different schematics, and understanding where overall institutional order flow is, and how banks are accumulating certain positions in that specific time frame. But anyways, scaling into why I sort of called this short there, we did have this prior engineered high which I felt needed to be swept. In addition to that, if we actually scale into this price range a bit more, we did have this prior imbalance here. And what I mean by imbalance is there is a gap in price here. So there's no price action to the left of it, and there's no prior price action to the right of it. So this suggests that this is an area of interest, and the reason this is an area of interest is because banks need to rebalance with this pricing in order to see lower pricing on gold. So this is one of my areas of interest. And my second area of interest was a formation on the 5-minute time frame, and the reasoning was this last up candle before that very bearish impulsive move. Why didn't I use this candle here? Because this was ideally the last up candle before that bearish move, and in addition to that, it was the only candle that had a full body closure, and as mentioned in the, I believe it was the week before market outlook, how I sort of favor full body closure sponsor candles, as they just work so much more effective than these sort of small doji contraction sort of range candles. Yes, on a macro time frame such as hourly or even 4 hourly, this may look like one candle, but in order to get them refined entries, we need to be scaling into the 1 minute, 5 minute, and arguably 15 minute as well. So yeah, that was my second area of interest, this last up candle before that down move. Why didn't I just use a confluence of both of them? Because our stop would arguably be, you know, a 45 pip stop arguably. So yeah, that's just not what we want to see. So yeah, just scaling into how this trade done. So we sort of had that missed / delayed reaction off our area of interest, and again, I always emphasize the importance of not getting attracted to FOMO. Meaning the fear of missing out. So we never want that feeling to sort of come into our trading, as we always wait for price action to come to us. And this is the reason I'm sort of creating this video. So if there's two different areas of interest, how I'd split my risk is 0.5% here, 0.5% here. And upon coming to one of those sort of areas of interest, I may get stopped on one, but I'll sort of earn double on the, or not double, but you know, triple, quadruple, 5 times, 6 times, 7 times, or even 10 times the amount when the trade plays out on that initial area of interest. So that's from an aggressive standpoint. That meaning you have a limit at the area of interest. And again, this was an aggressive entry, firstly being because we took the entry upon the area of interest, and secondly, we've taken the entry upon the UTAD phase. Now, just a little brief explanation on why that is aggressive from a Wyckoff standpoint. If we look at market structure right now, again, these BC, UTAD, and upthrust after distribution, what they are is free raids to the highs, right? Now, how do I know this is not just going to form a higher high, higher low, higher high, higher low, higher high, higher low, and arguably not just going to form a new higher high? You understand? So in that perspective, it was a bit of a risky entry, but nevertheless, it did play out to the T. Literally tapped our entry, and we've sold off ever since. But how else could we have capitalized on this trade using the area of interest methodology? So I believe someone did point out that you know, gold came to a retracement, and it looked like it was going to go for you know, it looked like it was going to sort of sell down to lower prices. And yes, that's the exact reasoning on how we capitalize on our areas of interest. So we see a reaction of this UTAD phase. We see that sell off to where we're taking out sell side liquidity. In addition to that, we've broken market structure. Now we understand the institutional order flow has turned bearish. From a 15-minute perspective, we can start scaling into smaller time frames in order to look for a valid reason to possibly short this. As we've taken out this prior sell side liquidity has been gained here from the bank's algorithm point of view in order to have that retracement. Again, we have this imbalance here that needs to be rebalanced. So again, scaling into the 5-minute time frame, we see this institutional candle, the last down candle before that up move, that took out this prior engineered high. Upon taking that prior engineered high out, we had that massive sell-off. So again, this would be an area of interest of mine here. And we've come to that to the T, right? Stops would arguably have to be above this high, but upon getting in this entry, you could always refine. But yeah, we've had that sell-off, took out that sell side liquidity, had that retracement into where? Into a premium pricing, right to the T, had that sell-off once more, and even from this perspective here, scaling into the 1 minute time frame. Let's say you missed this entry here. Let's see what we can find here. Exact same blueprint. So now we understand it's the exact same blueprint in the sense we sort of had that structural push up. We had this last down candle before the up move that took out this prior buy side liquidity. And the reason I call it buy side liquidity is if you look sort of from this high here to this high, is relative equal highs there. Upon having that small retracement down to attract retail to sell, there are stop losses present above this area here, and we know there's an institutional candle present over here on a 5 minute time frame that needs to be mitigated with. So upon taking out that buy side liquidity, we have that major sell off, and the reason I'm calling it a major sell off is because look how impulsive these bearish candles are compared to these small bullish candles. Arguably, yes, they are making higher highs, higher lows, but just look how long it's taken in order to reach a certain level. Whereas when we have that sell-off, you know, is a very quick and impulsive sell-off. But in saying that, we have this prior engineered high here, and again we have that institutional candle that had been hit to the T, and then we have that major sell-off again creating lower low, lower high, lower low, lower high, and upon that new lower low forming that lower high and that new lower low, stops would have gone to break even, and yes, we would have got out break even, but this is just a explanation on how you can refine your entries upon areas of interest. So yeah, I'm just going to quickly throw in you know, what could sort of happen on gold next. Just remove sort of all those annotations there. So yeah, now we've formed this distribution schematic, and we've got that test phase there, arguably over here. What I would sort of favor is a push into this and create that last point of supply. Upon forming that last point of supply, I would like to see these relative equal lows be relative equal lows swept, and in addition to that, this engineered low here swept. So again, I'll be refining my entries within this area here, but yeah, if you look at overall structural sentiment, we do have engineered highs here. So is it a case that we sweep these engineered highs and even come up to a more premium pricing to fill in this imbalance here? Possibly, but it's one of them. We are going to have to wait and see. One thing that I'm sort of hesitant about trading gold, and the reason I wouldn't really advise new entries if you haven't got into this entry right here, is because if we look at the economical calendar for tomorrow, we can see some very high impact news. So again, we've got CAD news, which don't affect it that much. GBP, yes, it will have an effect on gold, and President Biden speaks tomorrow. So yeah, this is going to be interesting to see how gold reacts, and more specifically the dollar. But again, that is high impact news that we have to take into consideration and understand how that could have a reaction on gold. Again, news is a catalyst in this market, so we could have a very impulsive move on gold, meaning I would really want to refine my entries to the T if I would want to take a position on gold. It's best to sort of stay back and paper trade this, you know, meaning write it down on the paper. You would have entered here, stop loss here, and just seeing how it plays out. But if you do decide to enter tomorrow, please use minimal risk. I'm talking, you know, 0.1% of your account, 0.2, no more than that. That should be the maximum risk, as those sort of market conditions, you know, is heavily news based, and technical analysis, yes, obviously it does come into effect with that, but when we understand the you know, power that sort of news has, anything can happen in the markets. But yeah, that's just a small explanation on areas of interest, why those two areas of interest of mine were present on gold. And targets for this, I do believe a major swing is due. Not swing necessarily, you can call this an intra-week trade. And where am I targeting exactly? This prior low here, and again, just looking at what happened with this low here, notice how I previously said these sort of wicks contain imbalance, not necessarily need of mitigation, but you just got to imagine it like this major consecutive down candle that formed this imbalance here. So all of this price action was imbalance pricing, and notice how there was no form of mitigation as such. There was sort of a rebalance in pricing as we saw this majorly bullish correction and then an ultimate sell-off. So that's what I expect on gold. First target would be sort of at this sort of area here. So again, that is a 362 pip trade, but ideally we could even come as low as that, making it a 400 pip trade. Just sort of round that up, 400 pip trade, and rebalance with this prior wick here. And if we do get that, I would like to see it come realistically to this last down candle before that move. So again, I'll be watching how price reacts upon the end of that wick there, as there may be a presence, there may be a sponsor candle present. Just check on the 1 minute time frame or 5 minute time frame. So again, yeah, this just looks like imbalance to me. Upon, as I mentioned, this wick formed on market open. So yeah, markets opened UK time 10, and we had that wick down, creating that sort of accumulation, wiped early stops out of the market, and then use that accumulation of retail orders to then see higher prices on gold. So yeah, with that being said, and there's no sort of sponsor candle on the smaller time frame, I do believe we could have a sweep ideally to this daily candle here, this last down candle before that move. Upon reaching this level here, I will then be looking for longs. But right now, institutional order flow is bearish, and I sort of don't want to change that bias on gold. Sort of looking at the overall risk to reward on this. That's a 1 to 37. Again, that's an exceptional amount on gold, considering how much it moves. And overall, that is arguably a 600 pip move with a 15 pip stop loss. So yeah, that's a favorable move. If you're part of that, hold your position. Make sure your stops is at break even, and yeah, let's hope for lower prices. That's Technical Tuesdays. I hope you all have a good night / good morning / good evening, depending upon wherever you are in the world. And I'll speak to you tomorrow in the mid market review. Thank you very much.